Paul.
All right, John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. We're streaming live as well on YouTube, so you can head over to youtube.com and search Bloomberg Radio. All right, Matt, I'm taking my year-to-date gains. I'm going to the 2-year Treasury. I'm giving them my money at the window. I'm going to get 5.04%. That's not bad.
You've got a lot of reinvestment risk ahead.
That's not good then. All right, well, let's talk to somebody who does this stuff for a living. Ted Oakley, founder and managing partner at Oxbow Advisors, is joining us live in our Bloomberg Interactive Broker Studio. Usually you're based, where are you based, down in Texas?
Austin.
Austin, okay. All right. So you didn't, your school, you're a Texas Tech guy. You didn't fire your coach and guarantee him $76 million, did you?
We did not. We don't have that kind of money.
Okay, very good. Just want to see what's going on down there in Texas. Everything's bigger in Texas. I know. I get that. All right, Ted, here, again, I can be just fine in my 2-year Treasury at 5.04%. Matt says I have reinvestment risk. What are you guys doing these days?
Well, we own a lot of that, actually. We have probably the highest level of treasuries we've had since 2000.
Really?
Yeah, we're very high in the treasuries. We have a lot of the floating rate treasury, which is even shorter. It's based on a 90-day reset every Monday, and it's about 5.5. And then, we own some 1-year, 2-year. We own some long paper, but right now that's where we have a lot of liquidity stashed.
Do you have? What are you looking for to maybe get more exposure to the equity markets? Is it a valuation thing? Is it an earnings thing? Is it a Federal Reserve thing? What is the catalyst that you guys are looking for?
Most of the companies we look at are guiding somewhat lower.
Okay.
In the coming quarters. We don't look at whether they beat or not because that's a game they all play, but we look at the guidance on it. And the guidance is going down for a lot of companies. And a lot of companies are just not cheap enough for us. We have companies we like. We've been buying some of the consumer staples because they've gone back down to a level that we liked, okay. But we've been, we still own legacy growth companies, but we cut back on them quite a bit.
So does that mean you're out of the market for the foreseeable future in terms of equities?
No, Matt, it means that we're about half in. Okay. You can look at it that way, I suppose. But, we really feel like that we'll have a better spot here in the next 2 or 3 quarters than we have right now. We really see weakness coming. We see it a lot in a lot of industries and across the country. We see transportation, retail, trucking. So many things are starting to weaken now. And so for us, we just don't think it's over yet. So that's why we're a bit cautious.
So do you have a recession built into your forecast here?
Well, you could have. I think it'll go so slow that it will feel like one at least. If you go to zero growth, Paul, or 1, that will probably feel like a recession to some people because some industries will be very, very slow. And then you have to deal with this debt situation with the Fed, too. I think that's a problem.
That's right up your belly.
Yeah, absolutely. I mean, do you see any kind of fiscal discipline coming to this government anytime soon?
I don't. I haven't seen it before. Now maybe they come around, but it takes both sides of the aisle to do it. And
does it matter to you? Are you concerned when you look at the debts and deficit? Or some people say we've been doing this since Reagan, we can keep doing it.
It matters to me in this respect. If you go back and look at countries where they get to a certain breaking point, and we're about 3/4 there, and people don't realize that the average debt that we're paying right now is about 2.6% on all the federal debt. Well, guess what? 50% of it rolls over in 2 years at 5. You're going to almost double it. And I don't think people realize what happens when you get so much debt and then you debase your monetary system. And I know it hasn't happened in the past, but now it's getting to a breaking point. You can follow it with countries over time and see what happens.
On the equity side here, I know you mentioned looking for income, so oil and gas pipelines?
We still have those. We rarely sell the oil and gas pipelines.
Why is that?
They're steady producers.
Okay.
They usually increase the income a little bit each year. If you wanted something to compete with your real estate on a private basis, you would own the oil and gas pipeline because half of them file on a K-1, just like real estate, so you don't have any current income tax on it. And secondly, they all pay between 7 and 9, so you get a
7 and 9% dividend yield.
Yeah,
and
right.
They're not building pipelines anymore, are they?
You hit the nail on the head. It's like I tell people, it'd be like trying to get an easement for a railroad track.
Right.
You think about that today. You can't do that. And then you have environmental concerns, and it's hard to get these days.
Well, I tell people when I was pitching to billboard companies back in the day, I said, they're not making any more billboards. Can't get them up. So
Yeah.
you got to buy the ones that are out there.
And how's that business going?
Awesome.
Yeah,
Awesome. You
Nice.
can't click through a billboard ad. You know,
that's true.
you can't block it.
That's true. What about other real estate plays? For example, in Texas, I know there are a lot of big data centers. There's a lot of big big warehouse businesses. You got a lot of land down there, right? So there's even green energy is a huge industry in Texas, despite what we may all think about Texans' attitudes towards that.
Well, that's true, but what we see, and I'm involved quite heavily in a community bank, and so I see a lot what's going on the real estate side. What we're seeing, Matt, is really we're starting to see even some industrial properties come up for lease because they're not full, and now we're starting to see some commercial buildings actually go back to the banks. I mean, they're giving the keys back, and so it's starting to show its wear and tear there too.
So do you guys, at the bank you're involved with, do you have commercial real estate exposure?
Very, very little.
Fortunate. Okay. But so are your customers, I mean, what are you seeing at that regional bank level? Is there loan demand there at these interest rates?
You know, in most community banks, Paul, the loan demand is about steady.
Okay.
It really is not going up or down. All the banks are fighting to try to get the loans, and so while you've got an 8.5% prime, they're having to come in at 6.5 or 6.75 and to get that business. That's what we're seeing. I think the banks are really concerned about it because most of them have situations where they have bond portfolios that are not all that great. And then the other problem is they can't get a lot of new, C&I new business loans. That's hard for them.
So broadly defined, I mean, Texas is so big, you can't talk about the state, but I mean, what are some of the driving forces down there for the economy? Is it still just people and businesses are coming into the state because of maybe favorable tax situation, good labor force? Is that still the story there?
Well, that's what we see. Now, at Oxbow, we do business in 40 states, so we do business all over the country. But in Texas, we have a lot of new business that came in just from people that moved from other states, at high tax states. They just got tired of what was going on in some of their states. On the business side, of course, oil and gas is still a big business in Texas, but we have a lot of manufacturing, we have a lot of tech, we have a lot of things that happen in the state. The state's it's still a place where you can go and sort of be a bit of a maverick. And I think that's why people come there.
Yeah, I'm telling you, man.
They like freedom.
I know, exactly.
It's in short supply.
Low taxes, man.
Yeah.
You're getting crushed here.
Tell me about it.
Tell you about it. All right. So, what's over the next 12 months, Ted? Do you think you guys will get more into the equity market, increase your exposure? What do you think you'll be making some changes to your portfolio over the next 12 months? What do you anticipate?
It would not surprise me to see us at least get a lot more. If we have a break in the market that we feel like things are cheap enough, you'll see us get almost fully invested. We'll find companies. We really run about 200, 250 companies that we would want to own, that we look at quite a bit. Most of those are not hitting the screens we want to buy right now.
And is that a valuation screen primarily?
That's a valuation screen. We like companies we find in the long run, you need to own companies that don't have a lot of debt. I mean, debt really for us is not working in the long run for companies. And we just feel like we'll get a shot at better valuations than we have right now.
What's your latest book? Stay Rich with a Balanced Portfolio?
Right.
So what am I doing there? Am I just risk reward, making sure I don't get too skewed one way or the other?
One of the things I've noticed really since the pandemic particularly is that people are really, they're all in one or two things. Like maybe they go all into cryptocurrency, all into real estate, all into the Magnificent Seven, all in something, and they don't have any balance. And one of the things I've found, and I've really interviewed in my life quite a few billionaires, and one of the things I've noticed about them is they usually have balance. You may not think it, but they have quite a bit of balance, have quite a bit of liquidity. And I see people today that are sort of complacent because nothing real bad's happened so far. And so they're all chock full of one thing. And I just think that's not a good way to go. If you want to, I'll just give you a note. If you took $1 million person in 1900, they'd be $1 billion today.
Yep, there you go. I could do that math. Ted Oakley, thank you so much for joining us. Ted Oakley, he's a founder and managing partner at Oxbow Advisors. You should get him on the phone, but he's up here in the Big Apple today, so we got him in the studio.
Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.